One of my most important points that I think is imperative for investors of all stripes to understand is that to have a balanced portfolio that performs the best under all economic conditions, it requires a portion of gold. When I was asked to write in the investing rules book so many years ago, I was asked to write the 10 rules of silver investing. And the 10th rule was basically too much of a good thing is too much of a good thing, which means that I recommended at that time 10% holding in precious metals was probably enough for most portfolios. Studies have been done since that time. One was done by Ibbotson and Associates, and it was commissioned by BMG Group, Nick Barishev. Nick is going to be with me later in this presentation to explain why a 20% holding is the best asset allocation, holding gold to balance the portfolio. But Nick's not the only one. Studies have been done in the past, Harvard University as being one of them, and also more recently, Jeff Christian from CPM Group has also done a study from 1968 onward to determine a balanced portfolio that measures risk and reward. And it holds around a 25% allocation of gold. This is something, again, that very few on Wall Street will ever mention to the investment community at large. The reason I'm making this video is I think that we are at the beginning of a big change in the marketplace. Equities overvalued by any metric you want to use. Bond market overvalued by any metric you want to use. Gold and silver undervalued, especially silver, by any metric you wish to use. So we're at a place where most investors should reallocate or rebalance their portfolios, which means sell things that are overvalued and purchase things that are undervalued. Yet you're not going to hear this in the mainstream. You're hearing it from me today. You're going to hear from Jeffrey Christian, CPM Group, Nick Barishev, BGM Group, and we're also going to splice in something from David Harquil, CEO of Franco-Nevada and chairman of the World Gold Council. All three of these gentlemen have something important to say about why gold is a requirement for a well-balanced and best-performing portfolio.
I'm chairman of the World Gold Council right now, and one of our biggest initiatives right now is to penetrate the pension funds, endowment funds, and sovereign wealth funds, because they own almost no gold. And so what you've had is that most of the ETF right now is held by hedgers, and we don't have the long-term holders in gold from the institutional markets. And so in April, we're having a special roundtable. We're inviting the top fund managers to hear from Alan Greenspan and other very respected people, have central bankers there, et cetera, to make the investment case for gold that we should have at least 0.5% of gold in these funds. And you just do the math, and you took if it was just 0.5%, we already learned from the GOD, every 300 tons of gold demand we create, it's worth $100 in the gold price. 0.5% would move the gold price by $500 to $600. That's the ambition. We think the World Gold Council, if we can get the ESG story right for the gold companies, if we can get the investment case across, we can start buying by the endowment funds and by these major pension funds, and that could move the gold price significantly.
David Morgan with you at the PDAC 2018. On my right, Jeff Christian, Managing General Partner of CPM Group. Jeff, we've known each other for probably almost 20 years, I think.
I think it's more than 20 years.
Could be.
Yeah.
And you know, you've brought something to the attention of investors that I think needs a wider berth, which is the requirement, my word, requirement to have gold in a balanced portfolio. You've actually talked about this twice at the Silver Summit, this year and the previous year, of why gold in a portfolio performs better than a portfolio without gold. Can you comment on that?
Well, very simply, you know, a diversified portfolio is best the more diversified it is, to some extent, depending on what you're diversifying it with. But if you add gold to a portfolio of stocks and bonds, what you wind up doing is reducing the volatility or risk of the overall portfolio's value. You reduce the downside risk of the portfolio by adding gold as a third set of elements there. And at the same time, you increase the return. So as you start adding gold Initially, you actually reduce the risk and you increase the reward of a portfolio over time, historically, since 1968. And then after a certain point, you start increasing the risk, but you still increase the rewards or the returns over time at a pace faster than you're increasing the risk. So by adding gold to a portfolio, you're diversifying away from stocks and bonds, you're giving yourself exposure to gold capital appreciation, and what you tend to do is reduce the volatility and the downside risk of the overall portfolio's value while increasing the return.
And you have an optimum number for that, correct?
Surprisingly, the number is about 27 to 30%, depending on whether you're looking at bonds or bills as the debt portion of the portfolio, and we use treasuries, so you could actually change it by using higher risk, higher return bonds and bills. But it's 27 to 30% from between 1968 and 2017, which is a very high number.
But one of your key ideas, which I agree with at the last Silver Summit, was all about what Frank Holmes calls, the love of the fear trade. You call it, I think, the greed or whatever. And would you explain that and why I think I feel it's more important than ever to get the gold story out there?
You can use different terms. On Wall Street, they talk about generating alpha or buying beta. Yeah, and generating alpha means capital appreciation. I'm looking for assets that are going to rise in value. And beta is capital preservation, which is portfolio diversification. I add this asset to my portfolio and I reduce the risk and I reduce the downside risk without negatively affecting the capital appreciation potential. So you could talk about capital appreciation and capital preservation. Gold provides many functions for investors, and people don't realize it. They think, oh, gold is there to protect myself from against fraud, or gold is there because the world's going to end. Gold provides capital preservation, and it also provides capital appreciation. And a lot of people don't appreciate the capital appreciation potential of gold, and gold mining shares, I should add. And so what you can do is when you're adding gold to your portfolio, you have to say, I'm buying some of this out of fear, that capital preservation. I am worried about what could go wrong in the world or in my personal life. So I'm looking for capital preservation, and gold helps me with that. But I'm also looking for capital appreciation. I'd like to make money. I'd like to have my money working for me. And a lot of people don't understand that gold actually does give you capital appreciation. Just holding gold gives you capital appreciation. Investing in gold, using options to enhance your exposure, and other things like that, using gold mining shares, increases the capital appreciation potential. So gold is really cool because it gives you gold appreciation and gold preservation. One of the things that we've seen over the last couple of years is people who bought gold out of fear have been kind of backing away. So gold coin sales, which are a fear trade, I want those gold coins that I can hold and carry with me as I head to the border. That's fallen in 2017, but gold appreciation, the greed trade, which is futures, ETFs, gold shares, and options, those things are at record volumes. Because what's happened is a lot of people are giving up the fear trade, probably at the wrong time. I think that the risks are greater now than they have been since World War II. But the people who are giving up the fear trade are giving up the fear trade to some extent. But you've seen a massive influx of new investors buying gold because stocks are very high and vulnerable. Bond prices are very high and vulnerable, and gold and silver are very low and are setting themselves up to rise in value. So what we're seeing is people buying gold and silver for capital appreciation or greed, and people backing away from the fear trade zone.
Why is it, with all the smart people on Wall Street, that gold is a word that they hardly ever utter on the mainstream financial channels, your biggest brokerage houses? I mean, across the board, you don't really hear anybody cheerleading.
It's very simple. If I'm a bank or a brokerage house and I sell an investor a stock, a bond, a mutual fund, an ETF, there is a 90% probability that that guy is going to liquidate that position within 13 months and buy something else, and I'll have another commission. if I sell him gold or silver, his heirs may sell it back to me, and I may get another commission on that. So when I was at J. Aron, we were a commodities trading company. We were bought by Goldman because Goldman wanted to offer precious metals and commodities to its investors. And what we found was the brokers wouldn't do that because that was just kissing those commissions goodbye. Once you sell somebody gold, he's not going to sell it back. So that's why banks and brokers don't push gold and silver. It's that simple.
Thank you. I love simple answers. Occam's razor. David Morgan with you at the PDAC 2018. On my right, Nick Barisheff. Nick and I have known each other for quite some time. Nick, thanks for coming today.
Oh, my pleasure always to meet with you, David.
You know, you spearheaded something that's been kind of a pet peeve of mine, which means that most portfolio managers do not admit the simple fact that they need diversification. They allocate stocks and bonds and think they're diversified.
Right.
But you know better. You did an Ibbotson study, or paid for one years ago. Can you tell us about that?
Well, the first thing Ibbotson pointed out is that there's 7 asset classes, not 3. So you have cash, stocks, bonds, and then you have real estate, commodities, precious metals, and collectibles. So for financial planning purposes, you can take collectibles off the table, but in Europe, the high net worth managers include collectibles. And since I'm a bit of a car buff, I always like to use the example that I think it was in 1967 Ferrari Daytona was 17,000 brand new, 2.5 million today, and it outperformed the Dow in any stock market going, and you could drive it Sunday afternoons. But anyways, let's take the collectibles off the table. So then we're left with cash, stocks, bonds, real estate, commodities, and precious metals. Commodities is a difficult one because you can't buy, for the average Joe, commodities. You can't buy a truckload of lumber, for example. All you can get is derivatives and proxies of commodities. So they're a little bit off to the side for pure commodities players. But the rest, there's easy to buy for any portfolio. So we've had REITs for 2 or 3 decades. We've had our mutual funds since 2002, and so on. So you can always implement with those. And the issue that Ibbotson pointed out, they had their models, but they did a variety of runs in terms of how much gold you need to protect for inflation and so on. And the numbers are quite simple. In their case, it came out to about 7-8%. But if you ask the question differently, is how much gold do you need to optimize the portfolio under normal conditions? So we've set up our own model and have run those examples, and like if you had held 20% in gold over the past 10 years, that would have optimized the portfolio. You would have reduced the standard deviation, you would have increased the overall returns, and you would have cut the losses, the drawdowns in say like 208 by more than half. So to me, it's a fairly simple exercise, and I can't understand why all the portfolio managers aren't doing this, because it's not brain surgery. They can set up your own model. We've got a giant Excel file. I can plug in, any portfolio you want, and add any percentage gold that you want, and you get the answer.
Right. Well, what's interesting is CPM Group, Jeffrey Christian, has done a similar analysis, and he's presented it at the Silver Summit 2 years in a row. And both years I've actually asked him on our mastermind, like you've been on, and it's the same number basically. It's 20%, and that sounds very high.
Right.
But it is what it is. You can't argue with the fact. And the fact is, with a 20% weighting in gold, you're better under all, I would say all conditions. Under conditions for the last 10 years at least.
Well, there are conditions in major market declines where you can argue 100%.
Right.
Okay, but that's like temporary, and then you redeploy it. But like if you forget about those, then 20% across the board is the optimum number between. If you go more than 20%, the return improves, but the standard deviation goes higher. Right. So if you're trying to get the optimum in between those, then that's the number.
Going back to Ibbotson briefly, if I remember correctly, I think they had like a 15.7% or something under all economic conditions. I mean, it was fairly high.
Yeah.
And that's like anything you can throw at it. So even in the best of times, if you have gold in your portfolio, it's going to outperform for safe risk to reward profile.
That's right.
My problem is that this is actually known by some financial planners, yet they're basically taught that they're diversified with stocks, bonds, and cash, which isn't true. And we all know that. So can you outline
the word
that?
Actually, diversification is holding non-correlated assets. And Harry Markowitz, I mean, he won a Nobel Prize for this particular point. And that is that it doesn't matter if you're holding 200 stocks or two, okay? The 200 stocks don't give you any more diversification because they're all correlated. You know, and it doesn't matter whether they're emerging market, blue chip, whatever, because when the market goes up or down, they all go up or down together. So you need something that's non-correlated. The most non-correlated asset class to the traditional assets is gold. So by putting it in a portfolio, it will always improve the portfolio because of this correlation thing. So that's kind of a straight black and white fact.
Right. So I would love to see like the Silver Institute, the World Gold Council, you know, that are helping the industry make this better known. I mean, it doesn't seem to be, it's an open secret that no one pays attention to. Wall Street doesn't pay attention to it. Obviously they're in the stocks and bonds model. They don't get much money for gold. Right. Even if you're in a wealth management situation where you have $5 million portfolio or up and you get a special phone number and your own broker. Even in those cases, very seldom they put you into gold, and if they do, it's like a weighting of, you know, 0.5% or something.
Yeah, we see the same thing. You know, one of my big underestimations was when I started the fund in 2002, was that I thought it would be welcomed with open arms and so on, and it wasn't. And I found out, you know, the hard way that there was kind of this negative bias against gold, which is being perpetrated by the central banks and so on. So okay, I get that. But the same thing applies to real estate. Now, as you know, my background is real estate. So when you look at, over the past 40 years, which asset class, if you take real estate, precious metals, stocks, and bonds, and which asset class has been the best performing the most often over the 40 years, real estate is number one at 17 years. Gold's number two at 12 years. Stocks are at 7. Okay? But if you look at the so-called balanced fund and the balanced portfolio, they don't have either. They don't have real estate and they don't have gold. Okay? And yet they're calling them balanced diversified funds or anything but.
Yeah. So what would you do to get the word out? I mean, you've already paid for the Ipsen study, you have a spreadsheet, you make this point very often, you make it in your literature, your writings, sometimes when you speak, yet it seems to go on deaf ears right now.
The trouble is it's one by one. We offer to financial advisors, say, look, you've got a portfolio that you recommend to your clients, so tell us what that is, we'll do the spreadsheet, and we'll show you what your portfolio would have looked like with 5, 10, 15, and 20% gold. And then it becomes like straight factual.
Right.
So that's the only seemingly way we can get through is kind of one-on-one, which is an extremely slow, painful process.
Right. Well, David Harquil, CEO of Franco-Nevada, was interviewed by Kitco at the BMO conference just a week or two ago.
Right.
And he said, as chairman of the Gold Council, of the World Gold Council, that he was going to bring in April some sovereign wealth funds, some pension funds, some other fund manager types, and he was going to actually have Alan Greenspan speak to these people about the requirement. Oh, I say requirement, I want to mix my words and say he said, he implied that you need gold in a portfolio.
Right.
And I think coming from someone as esteemed as Greenspan, people will listen.
Right.
Do you think that this will have any effect? I mean, I think it's important for the World Gold Council to promote gold in the correct way, which means it's a head position in most cases. It balances a portfolio. It makes you sleep better at night. I mean, it performs its function.
Right. But like I say, there's kind of this mental block that many financial advisors have. We've met with many of them. And the issue is that what they don't realize is they think that they really don't want to get into this realm of gold and recommend it to their clients and blah, blah, blah. But what they don't realize is when the market crashes, not if, and those high net worth clients are having lunch together, and I'm moaning and complaining saying, shit, that was a real shit kicking I took in the markets and lost 50, 60% of my portfolio, and you say, well, Nick, I didn't lose any because my financial advisor put me into gold. And what I lost on the markets, I made it up in gold. So I'm going to say, what's your financial advisor's name, David? That kind of thing is the way it happens. And in some cases at a high net worth, the guys that have, tens of millions with you.
Sure.
I've dealt with them over my entire career. These are not the guys you want to piss off.
Right. Yeah.
Okay.
Well, I agree. I mean, my scenario is one of my overused expressions, once the ship is sunk, everyone knows how it might have been saved.
Yeah.
So if you have gold in your portfolio, it's going to save you during a market crash. But try to tell that ahead of time, and people give you the short shrift, they don't want to talk to you.
But here's another thing where the complacency comes in, because this is part of the extended speech like I did in Barbados, and that's the issue, and I'm rounding out numbers, but there's about 300 trillion of global financial assets. Stocks, bonds, mortgages. When you look at the above ground gold, you ignore the central bank holdings, the jewelry and so on, and then in terms of what I call investment grade gold, that's 1.8 trillion. But we don't know how much of that is held by the world's wealthiest families, like the Rothschilds. That isn't ever going to be for sale. But let's say it's the whole 1.8 is available, and the market tanks and people start scrambling for gold. Now in 1960, the average portfolio had 5% allocation of gold. Today, it's 0.5%. So if today you went from 0.5% to 5%, and given that mine supply couldn't adjust quickly enough, all you can adjust is the price. And again, assuming that the entire 1.8 is available, what I would say less than half is. But if you get that adjustment, you get a price of 11,000 an ounce.